And welcome back to the Dukascopy Studios here in Geneva. It's time for the technical viewpoint of the market with Mr. Bruno Estier. So welcome back, Bruno.
Good morning, Jessica.
So 2 weeks ago, you were very prudent on US equities. So how do you see it now?
Well, let's look first at the daily chart of the S&P 500. And as we see, we do have typical figures, which is a triangle with a resistance around 1990 and rising support with support around 1940. And the momentum is slowly moving up on both sides here down. So it's relatively likely that if we break 1990, we'll move to the next level, which is the former floor here on July 2040.
So is the S&P the key factor?
Well, the S&P yesterday evening, if we look at BR-hourly charts, we have the same pattern of a triangle. We'll see that really in the afternoon and later in the session it went up. And it went up to this level 1988, 1990. Also, in addition to that, we see an element that technicians use, which is this red cloud band here. Usually short-term trader will react positively and tend to buy once we break above it, and that's relatively likely to happen. But I think there are still risks of failures.
So Bruno, what is worrying you?
Well, let's look at the different internals of the S&P 500, namely the sectors, the US sectors. And we'll see that, first of all, we have a first group of three sectors: discretionary, technology, and industrial, which have a relative strength, which is our rising line here in dotted an orange line, which is making new highs. What does it mean? That means that these sectors are outperforming the S&P, so these sectors are the locomotive of the S&P, taking it up or lifting it up. But when we look at the detail of the sector price, we notice that where we closed yesterday was effectively at a resistance, a ceiling. But above it, there are more over ceilings, if you wish. And these over ceilings are represented by the dotted red line here, coming up close to the moving average of 40 days and so on. So a spike up can happen, but it can also fail later on. If we look at the other sector, which is dragging up the S&P, if you wish, the technology, people used to think that big techno caps are dragging the sector, the S&P up. This is indeed the case, but we see also a similar pattern where we have descending trend line. And the third subsector, industrial, had been relatively weak during June and July. It was the descending relative strength line. It's now moving up again, which is good news because that means that the sector which has been sold is probably rebounding. But we also see here in the detail that we do have quite a few resistance trend lines, namely near the upper Bollinger Band, which is usually the upper part of the range where it could go. So here it's a little bit wishy-washy.
And Bruno, what about the other sectors?
Well, the other sectors, what it remains? It remains three groups. First of all, the so-called defensive sectors, healthcare and staples. Bad lucks, even though the relative strength is about up, if we just give it the benefit of the doubt, really on a nominal basis, the sectors is not doing much and we can expect further sideways move. Staples, a little bit better because it's trying a form of a triangle like the S&P, so it could move up a little bit, but the relative strength is not really strong, it's quasi flat. Then we've got a second group, which is financial and utilities. Both are usually impacted by interest rates. We should see, as we expect interest rate to rise, a stronger relative strength, but we do not see that. It's about flat, and here we're still below key resistances. And the utilities even worse, we're at the bottom of the range and the rebound is quite modest. And finally, we have the two old draggers, the one which were dragging the market down, namely materials and energy. Both, again, after trying to bottom, their relative strength is moving down here. And we'll see also the similar things for the S&P on orange. We see that despite the fact that oil has rebounded, that the black line, the orange line is slightly coming down. So if these two sectors are coming down, that means the old problems are still present. What were these old problems? That was the fact that commodities were moving down. Commodities were moving down because growth globally was down. So we see that really we do not have a big change of perception within the sectors. So probably what's happening here is probably some part of short covering on the S&P itself, and it needs to be seen if it can be sustained.
And Bruno, is Europe telling us anything?
We wish it would, but it's not the case. We had in the first part of the year a rising relative strength of Euro versus S&P, and we see it's not the case anymore. And it's flat. Even we could be a bit pessimistic by saying it's slightly moving down. So here we are within a small range and no signal at all. So I think what we need to really realize is see this last chart of the US 10 years interest rates. We know there is an announcement this afternoon, and before this announcement already the 10 years is taking yesterday 10 basis points on the way up, which is quite a move compared to what has happened over the past 3 weeks. And if this move is reaching the same kind of clouds, and we know that above that cloud, short-term traders tend to react to that. That means they will tend to push interest rate even higher. The question then is rising interest rate, long-term interest rate, so good for equity? And we will see maybe next time.
Absolutely. Well, Bruno, thank you so much for coming in today and sharing your insights with us.
You're welcome.
And thank you for watching. For all the latest Ducoscopy updates and interviews, do keep clicking back. Goodbye for now.